Hello everyone, hope everyone is doing okay. Let's do an audio test. Audio video please. How's everybody doing this nice afternoon or evening or morning, wherever you are? My name is Simon and we will talk about a few things today, including the importance of using volume profile and the system or having a system that would help you achieve your goal in trading. Again, let's do an audio test. Thank you. Thank you. Thanks. Ashton, Leggy, Ahmed, Trader. Thank you so much. Okay, great. Warner, hello. Thanks. Excellent. So, I will start with the basics. And to me, this will be a way for you to understand my input on how traders should look at trading. What is required, the basics, and then we can advance the information slowly throughout this. I'll try and keep it around 40 minutes to probably 45 minutes, and I'll be open for questions after. So let's start with this. The basics. To achieve a good trading methodology, one must follow these steps. Again, we cannot argue about this. There's no argument about this. This has to be available or has to be done before you start trading. First of all, the number one is anticipate. Trading is about getting into the market and try and get into the right side of the market, whether you're buying or selling. So if you cannot anticipate the move ahead of time, you should take a break and go and learn how to anticipate. We have a methodology, we have a system, and I'll do my best to convey the method, convey the knowledge. And if you want more, we have a YouTube channel, and we have educational videos that will help you more, of course, and we will be available to answer your questions via emails, etc. Second is to confirm. Now, once you anticipate the market, anticipation meaning the market will stop at this area and it will go up or down. Or it's going to go up continuous or down continuous. But that's not a way to trade. You have to also learn how to confirm your trade, and you have to stick by the rules. Of course, sticking to these rules, to your own rules, is important. Now, you can anticipate with the methodology that I'll be proposing, or you can have a different methodology, regardless. But anticipation is key. Same thing with confirmation. If you cannot confirm before you execute, there's no point in getting into a trade. So far, I think it is important. And execution is important because that means your trade management. I have seen over and over traders that would go in a trade, get into a trade, and they win. The trade is winning, but the end result, they lose money. It's not logical. Okay? So therefore, we have also to understand trade management is key to your success. Let's go to the next slide. Now, in order to anticipate the market, I and anybody who follows my methodology use volume profile. Of course, there are other indicators that they use or I would use, but the main indicator is volume profile. So what is volume profile? Let's take a look. Right here I have a 60-minute chart for US oil. Volume profile is on the right hand side. See? What does it mean? How does it work? Let me try and be a little bit more clear about how does it work and where did that volume profile come from. We're all familiar with this here. We call this bid and ask ladder or accumulated numbers or something like this. You see this? We have bid and ask ladder. The numbers of this is 1 hour candle. The numbers on the right and the left of each candle meaning numbers of contracts bought and sold. It's supply and demand issue, right? It's a supply and demand indication. So this is the supply and demand. This is the delta, for example. This is just the difference between supply and demand, and it gives you a number. Regardless of what it is, this is volume, number of contracts sold and bought. Now, here's the thing. If you have just one candle, or one candle, for example, the last candle that is designed, this is the last candle that you see, right here. This is the candle. It's ugly, it's fine, but at least you understand. This is the candle that you have, or two candles. Now, how can you assess volume within the last 2 hours, reading the numbers? You would probably assume that we have, you can gaze at these numbers and you'd say, okay, we have numbers here, high numbers here, and but would this help you in any way? I don't see it help. Even for people who depend completely on order flow or bid and ask ladder, they still they have to guess, right? And using your naked eye doesn't help. So really, we don't know where the volume is until we get the accumulation of the volume in this area between this candle and this candle. And with that, we have the volume profile. That is one of our base or main indicators, or studies as they call them with Sierra charts. And if I bring it up with pressing on Control plus, you should see it coming up slowly. It is very slow, I think. 1 second. You see it's accumulating here. See it's accumulating here, Control plus. So what this tells me, between the last two candles, as you see, of course you can sharpen the edges, as you see, and you can smoothen the edges. It's really customizable. You notice that we have high volume area between these two candles right in this region. This is the highest volume. Let's call it the point of control. So between these two candles, the point of control is here. This will become helpful once we advance in this presentation. It will help us. We have lower volume here, still, considerable volume, but it's lower, and we have lower. And you notice we have the blues at the ends, and we have the grays, right? It will be considerable. Now we have between this area and this area, you see, although there's orange and there is red, but it's basically kind of the same, almost the same. There's not much difference in it. So that's how the volume is being read, right? High volume, low volume. Now, let me bring a little bit more, because this volume profile is designed to read whatever you have right in the chart. It's dynamic. So if you have 3 candles, it will read only 3 candles of volume. Let's bring more. See, 4, 5. Let's bring more. And all of a sudden, I'm sorry, I keep shifting this. And all of a sudden you see that there's no need for you to see the numbers altogether. There's no need for the numbers. So far so good. Now if we look at the hourly since the 15th of May or even 14th of May, or maybe more, we realize there are now levels for the oil that created continuation, created resistance and support, all with reading the volume profile. So far so good. Next. Now, the way I read volume profile, the way I like to understand volume profile is to understand volume profile, the rejections and continuation zones in volume profile. Why do I need rejections and continuation zones for anything? Why do I need that? Here. If I am trading and if I am shorting a market, isn't it important for me to know whether this short move is inside a continuation zone, a zone that will make the market continue, like this zone here? Isn't it important to me? Isn't it important to me that to know there should be a spot where the market is going to be rejected, the price will be rejected? It's important. Now, there are a lot of indicators out there that people use, including myself, such as Fibonacci's, trend lines, RSIs, MACDs, all of them, but they don't give you that comfort level knowing the rejection zones, because nothing beats volume and value in the market. Even when you buy and sell, when you buy something, it's all about the value that is presented and the volume of that subject that you're buying or selling, right? So let's look at the charts again and determine a few things. Let's not look at these ugly candles, because I don't like to look at them. Let's look at an actual 60-minute chart. See, it's the same as the 60-minute bid and ask ladder. It's almost the same. See, same thing. Now, in this chart, this is an hourly chart. Why do you think the price of the oil rejected from here, and again from here, and again from here? What does this tell you? If you don't have volume profile with this, you wouldn't really know why. But once you have volume profile, initially it started with this look. Let me go back. Let me hide whatever happened after. But if you see this, how the market moved once we got to this level. Once we got to this level, there was a rejection here. This is a clear rejection zone or area with volume profile. Of course, we had another indicator, which was power line, which I can explain later. If I fail to explain any of these indicators during this presentation, we have clear videos on those throughout our video library as well. But you notice how the market moved fast here with the wick inside this gap area. And once we got into this gap, it continued in this continuation zone. So this is a continuation zone. I'm giving you free education, free information now for those who want to try and learn how the volume profile works and how I use it, right? This is a continuation zone. And all of a sudden, within the continuation zone, it jumped away from the continuation zone. It tried to cover this gap. It failed to cover this gap. Market doesn't like gaps, not gaps, I mean low volume areas. A gap is, we all know the price gap when you have a gap on the price. But this is not that. This is a low volume area where the price decided to get rejected, because the market doesn't like low volume areas. And if the market goes through a low volume area, it usually tries and covers it fast. Like a wick, you see the wick, or fast movement, such as, look at this here. What do you see here? Do you see a fast movement? This was a low volume area at that time. I hope I'm not being very fast in explaining, but at the same time, I don't want to be boring. You see how the market covered this area fast? You see this area? There's a reason for it, okay? So now going back, see how many times the market rejected this low volume area. And while it was rejecting it, the market was going through this area. It created a red area, we call it knife. We can also call it a point of control, right? So far we realize that we have zones on volume profile excuse me, we can call them continuation zones. You see, they look alike. The whole area look almost alike, the same kind of volume, except for this, which not a big deal with this. For you to generally understand this, the volume profile will give you continuation zones, such as this one. It looks almost the same. The whole volume and area looks the same, almost. This is a continuation zone. Hopefully you get the picture, folks. When you have volume accumulated and it looks in terms of size and color the same, right? Of course you can change these colors, then that's a continuation zone. So this is a continuation zone, this is a continuation zone, this is a continuation zone. Do you know what else is a continuation zone? This is a continuation zone right here. Some people will say, you just said this is a rejection zone. Yes, but when the price goes into it, after a few tries, we can consider this a continuation zone. The market will try and cover it up, try and go through it. Okay? And of course, we have other indicators to help, but these will be used for confirmations, which I will be trying and talk about these indicators later. And we will have some examples too. I will do my best to explain as much as I can and answer questions. You have also, if you notice this level here, of course, when I look at something like this, to me it looks beautiful. To somebody who's not used to this, they will say, what is this, all these edges, sharp edges? But to me it looks like this. I will mark it, I will show you. To me it looks like this. You see? To me it looks like this. So now if I hide volume profile, I cannot hide it unless I click on the mouse. Never mind. But it looks like this. It looks like beautiful continuation zone versus rejection zones. Okay? Let's look at something else. Let's look at the daily or one-day profile on US oil. What do you see? Same idea. Look at this. Look at how the market got rejected multiple times from here because of, at that time we had volume, low volume area. If you see this, I'm just trying to speed up the this thing here. Watch where the market is stopping. Always volume will lead the price. Now, you see this? Do you see the difference between this zone and this zone? And in the middle you have a rejection zone. So we have continuation, 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 and in between you have rejections. So far so good. Any questions so far about this one, this thing here? This is basic knowledge. This is intro to volume profile. Any questions so far? Very good. Now, how I use these zones. This is the most important part of this whole presentation because this will give you an idea how I use the volume profile and how I manage my risk using it. Remember, number one slide, we talked about anticipate, confirm, execute. Volume profile, it's tremendous in doing that in some cases. In a lot of cases, if you wait for it, if you wait for the right place. And I'll explain how. And I did this diagram to help me understand what I'm presenting next. Okay? Let's go and take a look at what do I mean. We talked about zones, and we talked about the zones for you might look ugly because maybe some of you are not trained on how to see this. Even if you look at pound yen, for example, the pound yen. You see? You look at Aussie futures, or Aussie um, Forex spot. This is Aussie, this is Aussie USD, right? This is the pound, and this is the pound in the futures, and this is the pound in, this is, sorry, pound US, and this is pound in the futures market. Same thing. Nasdaq the same. One of my favorite instruments is the Nasdaq, or the NQ, NAS 100, which is NAS here. All right, we are touching a very prominent resistance level now. So see that. Now let's go back to US oil, and let's go back to what I'm planning to explain. One second. Now let's assume that you, again, don't take it personal, just anybody, anyone, is a complete technical indicators or technical analysis trader, and you have levels in the market. First of all, you wanna, the market is going up, and you decided to take a long if you have a retracement. Now you have levels here. This could be RSI, could be Fibonacci, could be anything, power line, trend line, whatever. Let's focus on the simplest one, and something I use too. I use religiously, which is Fibonacci levels. Let's assume that you want the market to retrace to either this level. This is could be 38%, or this level, or this level, 62%, or maybe another level. So typically what you're gonna do, you will wait for the market to come back down. Maybe it's gonna go up much further, then it's gonna come back down, and then you will take a trade long here, example, and the market will continue down, will stop you out, and then you will say, no, maybe this one 50% is cool. 50, this is 50%. You will take another trade here, it will go in your favor for a few ticks, and then boom, down. And from here it's not going to even get to 62%, it will continue going up. Now here you will take maybe another long. You will say, no, it's honoring the zone, the area, let me take it because it's an uptrend. It will stop you out, it'll come back down, finally will touch 62%. It might not, but it might touch 62%, but by then you already had 3 losses. You're gun shy, you don't want to even touch it. You go, to hell with it, I don't want to trade. You'll see it going back up. Or maybe at one point you will get tempted, you will come back because you made 3 losses in a row. You want to make your money back for the day so you can feel better in the evening. You will take another trade, and boom, comes back down, another loss. And you will say, what did I do? I promise I'm not going to do this again. Familiar, right? Now, if you know the zones, if you're familiar with the zones, you are guided. You're making wiser decisions. How so? Let me explain. Now, the zones previously on this trend, they worked such as this. They had previous zones, and you had a zone maybe here, and then another zone here, or maybe all in one zone, right? Simple, or maybe all in one zone. Let's make it simple. This was all one zone. The other zone is attached to this zone, similar to what I showed you. Some zones are attached together. They will continue. They will look like, they will behave like one zone. So the market goes up. It reaches the top of this zone. The top of this zone is rejection. The middle of it is a continuation. Now when the price comes back down here, previously you traded this long. If you know there's a continuation zone here, would you have taken this trade? No, exactly. You will not touch this one. Market goes down again. Previously you took this trade long. Now, but you are still in the continuation zone. Would you have taken this trade? No. Finally, the market comes back down to the 62% retracement, and of course, This means there was another zone below it, and in the middle there is a rejection zone. Oh, sorry. And in the middle there is a rejection zone right here. Now what you do here, you decided it's not only a rejection zone, which is R, rejection zone, it is also 62% retracement Fibonacci, right? Worst case scenario, it might give me a little bit of a move up for me to take my first target or to make some money so I can move my stop loss. But to me, I think further. Why? What did we say about the slide? Managing the risk. And my last slide, if I show you my last slide, I say always question your risk before committing to a trade. Always question your risk before committing to a trade. So therefore, going back to this and going back to the drawings, if I find it right here, to me, the way I see this, folks, I see it like this. If I grab a trade in this area from, let me go green. If I grab a trade in this area for a long, or 62% Fibonacci for a long, I know my stop loss ahead of time. My stop loss will be the entrance into the next value area of the volume. I confused you. Value area of a volume. This is a zone. This is a zone. Look at this is a zone that I'm doing here. The value area of this zone, I'm sorry, my mistake. Let me do this clearer. This is a value or volume profile zone. We saw this in the charts, right? It looks like a dome. The value area of this zone is this. It's 68% of the zone. So the value area is here, the entrance, the exit, and this is the value area. We're good? So what I would do, I know my stop loss ahead of time. I know my stop loss will not be here randomly. It will be right here. Just getting into the zone. So now, if you are used to risking 30 ticks risk or pips randomly, now you can minimize that into maybe 15 pips. Just this alone, folks, this strategy alone can save you thousands of dollars, and it's a very mathematical it's very logical mathematically. If I show you, if you save just an example, each loss, if you encounter a loss a day or something, 15 on one contract only, times $10 times 4 days a week, you save $600 a week times 52 weeks, or let's say 50 weeks you're trading. That is $30,000 just with one contract, minimizing your stop loss from 30 pips to 15 pips. Logic, folks, logic. Everything is about logic. I got a message today from one student saying, how can you control yourself by not getting into the market? I don't react to the market. You're not supposed to react to the market. You're supposed to be a proactive trader. Once you know these things, whether from me or another system you have, whether you know how to anticipate the market, and whether when you have, when you know how to anticipate the market, and when you have the zones plotted in front of you, it's much easier to trade. Of course, trading is not easy, but we only make it hard by not following a certain methodology. So far, so good. Any questions, please? All good. Okay, thank you. Next. What about confirmations? Now, we also need to understand that what we talked about so far is anticipation. You anticipate the rejection, you anticipate the reversal, you anticipate the continuation, you anticipate the trade. But what about confirmation? Let me ask you this. What are some of the indicators that we use for trading, whether to confirm or get into a trade? I would say Fibonacci. I would say, and I've been repeating this, RSI. I would say, I don't know, any reversal rejection zones, indicators, most of which are technical. But how about if you use those indicators just to confirm? You don't have to use them to anticipate. Use volume to anticipate the market, and after that you use other indicators to confirm. Okay, let's get to the charts and see some examples. All right. If I can narrow this to one day. Let's see. 60-minute. Here, the market came back down in this area. You see this? It came back down to, this is the, we're continuing with the same instrument, which is US oil. The market came back down to this level and bounced. This was probably a level that maybe it was suitable for trading because it happened before. It's after the fact. I don't know. Let's see. Yeah, it was suitable. It's trying to poke the 50% Fibonacci. Let me remove these lines. You don't need those. So it's trying to poke the 50% Fibonacci and it bounced up. But this level, if I mark it with a, let me remove this Fibonacci. If I mark it with a blue line and scale down to another chart, 15-minute chart, what did I have at 15-minute chart to give me that comfort zone to buy or to get into? Again, I'm talking about hypothetical, right? You notice that in the 15-minute chart, when I scale down, you notice that there was a difference in volume profile between the upper level and the lower level. So there's an area that is rejectful. Plus, you see this indicator. This is a DRL, dynamic reversal level indicator, that it's part of what we use. So this is a very advanced indicator that we use, and we have videos on that on our YouTube channel. And maybe when I had power lines plotted on a 15-minute chart, maybe I had also a power line going through this. We don't have it here, but let's say look at another instrument. Let me look at the NASDAQ. This is a weekly chart, not useful really for this purpose. Smaller chart. This is the NASDAQ 100. Watch the rejection that just happened now on NASDAQ 100. You notice how the market rejected from here. You see it, right? Everybody sees this clearly. Let me just mark it as well. You see how the market got rejected from here. From here, we had also two different volume value areas, volume separated with the throat, I would say, right? And not only that, you notice the power lines. This is another indicator that we use, which I'll try and explain if I get enough time. And also we had another indicator that is an arrow, and how the prices started going through a continuation zone. Right? Now we have two power lines. One of them is red, or the other one is green. This indicates a resistance, but if it breaks it, it indicates a fast move. It indicates a fast move. So if it doesn't break it, if it comes back down, it's fast. If it breaks it and goes up, it's going to be a fast move. It's like squeezing water, squeezing the hose when you water your plants, and then release it suddenly. The water will jump. Same idea. So this indicates that maybe the time of the day is not good for this example, but usually there is a faster move when you have two intersecting power lines. So for the purpose of this slide, which is what about confirmation, I try and use some very good indicators. One of them will be the power lines, as you see. What are power lines? I'll explain. See what I have next before I explain the power lines. Just give me a second. I can explain quickly. So, power lines, DRLs. DRL is this one here. DRLs are these ones here, as you see on the right hand side. You see there's 120 minutes, 45 minutes, and you see how it stopped right at 15 minutes. You see this? The market stopped it. The price stopped at 15 minutes. So I'll explain these two, power lines and DRLs. We use them for confirmation. Of course, there are other ones, but these are the main ones. So a power line. You notice that there is a line here, starting here and going here and here, but not on the other ones. And same thing with the, see there's a small dot here on the red, and it's connected with another one here, but not these ones. So what is a power line? A power line is a combination of a fractal and end of buying and end of selling right on here. You remember we saw this earlier. We saw this. So the end of the tape, end of the buying and end of the selling represents low volume and represents rejection. So I use that for my power line. So power line is that. But what is a fractal? When you have a candle going up, and then you have at least two candles on each side or more that are lower lows, lower highs from this high. This is lower, this is lower. So at least two on each side. This will be a fractal, and it will link to another fractal. Same thing with the candle that's going low. So this candle is going low. See this? There's a fractal, and you have at least two highs on each. Two lows on each side that are higher. See? And this is a fractal. But of course, there are also rules. One of the rules is that if the line, or if one of these lines get broken, or let me show you how it works. So if any power line gets breached by more than 10 ticks or 10 pips, it goes away according to my setting. You can set it differently. So if you have a line, and the candle goes through it and closes 10 ticks or more above it, this line disappears. It's not effective anymore, right? Such as this one here. If you notice this one here, there was a red line here, but you see the market closed, one of the candles closed below it, so it disappeared, right? So these are rules. You can choose them according to your trading style. Now, what is DRL, dynamic reversal level? I did intense research in the past, and I came up with this indicator. It has six built-in very advanced reversal indicators on each time frame. One of them is 30 minutes, 45 minutes, 60 minutes, 120 minutes, and so forth. So when we have at least 3 of these indicators line up, oh, this looks like a face. So if we have three, at least three of these indicators line up or more, it will show up on a 15-minute chart. It will also show up on a 30-minute chart, depending on the same indicators on a 30 minutes. So these are all separate time frames embedded in one indicator. So you have a 30-minute chart embedded inside this indicator. When we have 3 out of these 6, or at least 3 of them, line up at the same price, it will show. And every 30 minutes, if these indicators change, this will shift to somewhere else. Some like 15 minutes. In the next 14 minutes or so, this might shift location because there will be another candle opening up inside this indicator, and it might shift it. Now, this is a lot of information, I understand. Any questions so far? Everything looks good. Everybody's understanding. Very good. Now, we talked about rules of successful trading. One of them is always questions your risk before you trade. Anticipate, confirm, execute. Now, if you know the market is going to a certain level, certain point, but you don't have an entry point, will you still trade it? Almost 80% or 90% will say no. But in fact, once you sit in front of your computer, you will do it. Realizing risk is more important than trying to achieve something. Almost every trader I know, they started with trying to get a home run with each trade. Right? Each trade to them, it's a way to get rich. You cannot do that. Or if they have a big loss for the day, they will come back and try and make it up same hour, same day. You cannot wait. Okay? So there's a psychological, what do you call it? Psychological issue. No, I wouldn't say issue, but attachment to this. We're attached to this. This is very personal to a lot of us. It's like if somebody calls me I'm a bad trader, I will be insulted. No, this is not who you are. This is something you learn, and some of us are good at it, some of us are not good at it. But some of us can be better at it, some of us can never be good at it or never be better at it. So it's all about thinking about it as a business. To me, I don't think trading is a hobby. Gambling is very close to trading if you mix them together. So the way to avoid gambling is to try and always understand the market is there to help you, unless you go against it and try and do things that are not reasonable. Here's an example. I'm going back, folks. So how many times you would have thought if somebody grabbed a short or took a short on this Nasdaq being a 62% retracement? Sorry, I'm going back for a reason. From here, you would have been successful. From the look of it, you would have been unsuccessful, or would have lost all the trades that you took short because the market went up. In fact, I marked that level with the blue line, and what you see is that, look at this beautiful successful trade here. This is huge. This was maybe a few hundred ticks or pips, right? Especially if you look at the NAS 100. Same idea, Nasdaq or NAS 100, doesn't matter. But if you have left your trade open, if you traded with 3 contracts and you left them all on the table, thinking there's going to go 500,000 million ticks in your favor, you would have lost money. See, it would have stopped you out. But if you have taken the first 2 contracts out, 2 contracts target 1 at plus, let's say, 100 ticks, you would have made 200 ticks or pips, right? Profit. And if you had a stop loss then at break even, you would have not made money on the last contract. Same thing here. Same thing here. Same thing. So point is, folks, trade management, which is anticipate, confirm, execute, is key to your success. Okay? And following a methodology. Methodologies are there for you to follow, whether this one or other ones. The idea is to follow a methodology and to be able to control that urge to trading randomly, right? Why do I prefer CFDs? You saw I'm doing U.S. oil, NAS 100. I didn't do an example for, let's say, pound US. Although I like pound, I like the pound, euro, US, Canadian, whatever, I like them all. But with the indices, they are linked to futures as well as the forex, as well as the currencies, of course. But with currencies, something I don't like is that the currencies are also controlled with politics between the countries. Let's say US versus the pound. The countries will try and influence a certain price to keep it balanced. And I've noticed that throughout the years. And even if you look at the charts of these instruments, let's go back to and see if I can find a chart. Pound yen. Oh, not this one. I want to look at a long-term chart, folks. Even if you look at a chart such as let's look at, what is it, Aussie, pound, USD. You notice there's a lot of back and forth, back and forth, back and forth. There's not really a good level, especially this is the daily. Imagine the hourly. Look at the hourly. It's always ugly. Look at this zone. This whole area is ugly. With the CFDs, the oil I like, the silver I like, the SPX, which is ES, the NAS 100 I like. Also nat gas you can trade. And the thing is that if you have a solid good broker, it will be all standardized in terms of pricing. You don't have to pay $5,000 margin for this, $20,000 margin for that. It will be all standardized, and you can treat it exactly as you treat the forex. They don't expire and they don't roll over. Okay? So this is one of the reasons I like CFDs. Our main goal, this is the final slide. We work with traders by stripping out their bad habits and conflicting educations. We all have that, conflicting educations, conflicting knowledge. Installing new knowledge and a fresh way to looking at the markets. I showed you the zoning based on our methodology, of course. Because the correct way of reading any market is through its value and volume. And with that, I thank everybody. Thanks for your time. Any questions? I'll be here to answer questions. I'll be waiting for any questions, any feedback. We do have more information, detailed information, on our educational page and on our website. Also our YouTube channel. Try and focus on the different playlists that we have, and let us know if you have any questions. Thanks everybody. Appreciate your time. All the best, and bye for now.